Good morning, team. I'm here for an early morning walk at the beach as we see the sun coming up. I wanted to have a conversation today about real estate purchases and what I see going on, and really to have an honest conversation of what I think one should do. I know it's a big topic with many of our viewers and many of your friends and family about when's a good time to buy a home. Is it a good time now? Should we wait? Should we not purchase? How should we even look at the real estate purchase? So I want to give you a perspective as we look at the housing question. I see a lot of information out there, and I want to sort of give you the best angle I can on this and talk to you as if I were talking to my daughter or my friend or colleague or a student along those lines. So I'd like you to come on this journey this morning as I walk and talk, and as we think about where we're headed with these uncertain times in the marketplace. I want to begin by saying we need a historical look back on this, because since about the year 2000, as we've entered this new century, it's been a challenging time to buy, sell, transact, rent real estate. And so the historical perspective, really before 2000, how the world was. This is one of the good things about having some age on you. You can think back and see how things were. But historically, and for decades it operated this way, was essentially we looked at one's household take-home pay, and the thinking was no more than 1/3 should go towards your housing costs. So we understood that the equation was along those lines. 1/3 of your take-home pay would go towards total housing expenses. That could be your rent, or that could be your principal, your interest, your taxes, your insurance, and I would even argue a little bit of your maintenance fund as in taking care of a property, because if you've owned property, you've seen there are costs. Generally, when you're a tenant and you're a renter, that's borne by the owner of the property, the landlord. However, in a case where you own the property, those expenses fall on you. So I would say including setting aside some funds for repairs and maintenance would be part of that equation. But along those lines of 1/3 of your take-home pay, so obviously we have income, we have to pay taxes out of that. They're owed one way or the other, whether you withhold for them or not, you're going to have to be responsible for them. So we look at that basis, 1/3 of your take-home pay. And historically, as we went along these lines, housing for decades generally just kept up with inflation. So if you had a 3 or 4 or 5% inflation rate, that's about what housing appreciated with. So it was a slow process, and as you paid down your principal and as the house rose slightly, it was keeping up with inflation, and you were making progress by paying down your principal, so your home equity grew that way. It was a long-term proposition, and that's how things worked. Things began to really change, though, with repressed interest rates being kept down for a long period of time, falling and going down, and then being kept at a low point. We have had a 40-year drop of interest rates. And in this type of environment, bonds do well as interest rates are falling, stocks do well as interest rates are falling, and real estate does well as interest rates are falling. So we just ended in 2020 a 40-year drop of interest rates from very high rates. The Federal Reserve had gotten the discount rate, borrowing rates to banks, member banks, etc., as high as 20%. And it has come straight down over these 40 years. So during this period of time, stocks did extremely well. Bonds did extremely well. real estate being such a leveraged or financed asset, meaning most people don't pay cash for housing. So it's driven largely by borrowing costs, how much debt you can get, and how easy it is to get. So under this perspective of time where it was relatively easy to get financing and large amounts of financing and also at low interest rates, it drove up prices. So we've had a situation where prices have outpaced inflation by a lot. They've outpaced almost every other asset class in many comparisons that we look at. It was not that way before. What we would typically see back when I was younger was housing a third of your take-home pay, housing keeping up with inflation roughly. Interest rates rose when we had high inflation, and that tend to offset somewhat the rise in prices. It would be sort of a self-governing mechanism, and we would see this happen where high inflation, high interest rates to bring down the inflation, home prices fall, correct, and largely that was due to your housing payments would rise. So as balances were high and interest rates rose, borrowing costs rose considerably, so your purchasing power dropped. And that would self-correct, and we would generally see housing prices fall. So the bottom line from all that is over this period of time, housing equated to around 2.5 to maybe 3, maybe on the coast, 3.5 times your income. So it all kind of worked somewhat in harmony. So you think about it this way: if one made $50,000 household income, generally you were looking at roughly $150,000, $200,000 types of homes relative to that, because interest rates and inflation and housing prices sort of worked in this mechanism. So housing was something where you gained wealth by slow appreciation, not really much in terms of real appreciation because inflation was keeping up with it, but then you grew equity by paying down your principal over periods of time. So that was the equation for housing. So it was generally 2.5 to maybe 3.5 times household income. So even with more people working in a household and now more people working multiple jobs and things like that, when we look at that equation, okay, so the stunner now, we kind of look at that same equation that held for a long period of time. When we look at 2020, 2021, that equation amounts to more like 8 to 10 times household income. So we had an equation of 2.5 to 3.5 times prices versus income. Now we're looking at more like 8.5 to 10 or even higher on the coasts in the United States. We're starting to see this phenomenon happen as well in places like London or Stockholm, Munich, lots of different locations where we're seeing the equation be out of whack. So the mathematics, the algebra, if you will, really does not work at this time. So I'm trying to get your attention when we look big picture, having an honest conversation. When is a good time to purchase a house? Should we take a house in right now? And I would have to say this. I want you to think more like a chief financial officer or a chief executive officer of an investment fund. Because for a long period of time, people have thought housing goes up, buy as much house as you possibly can, leverage up as much as possible, and get into that house because they appreciate over time. So that's going to grow your equity by quite a bit. And sort of the more return on equity you can get, the better, that sort of thinking. But that's a terrible risk management approach. And I want to bring in an example, because if one is only putting, say, 3% down towards a house purchase, what that means is your leverage is 97% to 3% down. And that 30-something times relationship, 30 plus to 1. So for every $3 of capital, you've got more than 30 times of debt. That equation, around 33 to 1, was what Lehman Brothers had when they failed. It was incredible leverage when the markets moved against them. And so people who purchased in these last couple years with leverage like this, believing it would continue to go up, as now they're facing a decline in prices, the return on equity from historically being wonderful turns into a really ugly situation where you have big negative return on equity. So as we have this conversation, I want you to look at the risk parameters, because right now the prices in relation to people's incomes have been extraordinarily high, bubble territory. Now we're in a situation where interest rates are rising dramatically. We have to crush inflation. I believe interest rates are going to stay high for a while. I don't believe there's going to be a quick drop when I look at things. When I look at the inflation around us and I study markets, I see that interest rates are here. They're going to stay considerably higher than they've been. They're still not high based on historical averages. People got used to a decade of near zero interest rates. Lots of asset classes make a lot of sense when interest rates are repressed and very low. I'm just saying, honestly, at this price point, for most markets, getting in, purchasing now, could be a really risky proposition, and I don't think the numbers favor you. I think in these environments, actually, renters come out better because those holding the assets that are financed, those with big mortgages, things are working against you right now. At the same time, we've got a slowdown in the economy, and in some markets, rents are actually falling. So it's kind of a toxic mix right now when we look at it. Which brings me to another point. When you're making this purchase, first of all, 30-something to 1 leverage, 3% down, 97% loans. Some people are 0% down, infinite risk in that sense. It looks good. If prices rise 10% right after you buy it, it looks wonderful. It's an infinite return on your equity, but it doesn't look good when it goes down. We're at a point right now where I don't think the risk parameters make sense to get in with this interest rates. And on the other side of the equation, when I would purchase things, I learned from some multi-millionaire real estate investors, and some of the things they say made a lot of sense. And one of the things I would hear them say is, when you purchase something, no matter how much you love that house and think you want to stay there forever, you may not be able to. Many things could change it. A transfer, loss of income, family changes, whatever it is. So you should only purchase something where the equivalent rental for the market, the rental rate would cover your principal, interest, taxes, insurance, and maintenance. So you don't want to buy in a market where the rental of that same house doesn't justify your payments. So if your payments are considerably higher than the rental stream from that property, you don't do it, or you get your payment down to a level below the rental side. So that's self-governing in a way. You can't leverage up so much because you're being kept honest, if you will, by the rental markets. And in some places, I see it in coastal California a lot of times, the rents don't justify purchase. I mean, you would really need to put a large down payment to get your payment down to that level. But that is a cash flow stream, if you will. You look at the house like a fund manager or a chief financial officer. What kind of income stream comes off this? Think of it as a business. What would this house generate in income? Does it cover my payments? If not, you should not do it. You need to get to the position where that rental income for the foreseeable future is going to cover it in case you need to move out and you need to go rent, or you need to move to another part of the country and you can turn it into a rental stream. But because we have lost the ratios that we had for a long time, where housing prices were 2.5 to 3.5 times household income, and we were not spending more than 33% of our take-home pay on total housing costs. Because when we look at our budgets, you have expenses, for example, like food and energy and insurance and going to the dentist and transportation costs and vehicle maintenance and your household expenses that will come and continue to flow. Just because you spent too much on housing doesn't mean those things go away. So we have to be realistic with it. We all should be saving 15, 20, 25% of our take-home pay for the future. So with those parameters, most housing markets don't make sense. I do say there are places, though, where it does make sense. And there are some markets that are less impacted by the financing market. Now, most of the studies show, with respect to the Federal Reserve Bank system in the United States, that housing prices follow financing. So interest rates historically would rise with inflation, and that would self-correct. So housing prices would fall with rising interest rates and rise with lower interest rates. We've had 10, 11 years of near zero interest rates. Housing prices skyrocketed. Now we're in a situation where mortgage costs in the United States, the end of 2021, you could still, with good credit, probably get a mortgage around 3.5%. Now it's 7.25%. It's more than doubled. Housing prices must fall unless interest rates drop back down to 3 from 7. The markets are such that housing prices are going to need to correct, to fall in most parts of the United States. There are markets where the ratio of household income to pricing is not as bad, and there are some places where it's very much out of whack. But once you get to a point where you're looking at rents and housing prices above around 12 years of pay, you start to have some issues. Let me give you an example. If somebody made $100,000 a year in household income, the old ratios would have been the rental rates were about 120 times the housing price. All right, team. So as we wrap up this consideration for buying a house, I want to put a couple points on the board as we're talking about this. First of all, if the conditions are right, by all means do it. But I just do want to wrap up a couple points that I have talked about, that I've placed on the board here. Okay, so as we look upon this, factors to consider. All right, first of all, we are in a 40-year bull market that has just ended in recent times. That bull market has ended for bonds, stocks, and real estate, all at the same time. So interest rates have taken this long fall down. So we had great booms with bond, stocks, and real estate. Okay, so now that's the big picture backdrop. Interest rates have gone up quite sharply, but have a long way to go. They've come down over that period from 20 to around 1. So now they've moved back up some. Okay, secondly, median home prices in relation to median household income are at all-time highs. So when we look at cash flows from houses, we look at rents, we look at cash flows from people's incomes versus the home price, the ratio's at an all-time high in terms of home prices relative to those things. All right, so next we come to the fact that homes, about 80%, give or take in America, are financed. Very few people come in with cash and buy a home. they need a mortgage, they get a mortgage. So as a result, it's a highly financed asset, so we have to look at interest rates. Now, when we look at this, we see that mortgage loan demand is falling rapidly. Surprising in many instances how quickly it's falling. Rates have gone way up. It looks to be recessionary right now, so demand for loans, for mortgage loans in particular, dropping very quickly. So that will lead to a lack of demand, lack of purchase offers and things like that. We will see home prices continue to fall if people aren't even applying for their financing. The affordability index right here, which looks at incomes, interest rates, home prices, what can you qualify for? The affordability index, basically for the median person to buy the median home price, we are now at the worst level that we've seen since the mid-1980s. To just give you a little perspective of this, the last time it was this unaffordable, here's a couple of the songs we were looking at. Jump by Van Halen. We had When Doves Cry by Prince. And Tina Turner brought us What's Love Got to Do with It. So it's been a while. Many of my subscribers and viewers were not here at that time. But you can find those songs to get an idea of where things were. So it's been a long time that it's been this unaffordable. So we have a lot of factors which would lead one to believe it's probably not an ideal time to purchase. The prices have the indicators, sharply flashing right now, saying home prices would likely fall. So I wanted to kind of give you a big picture. Price of homes relative to incomes, price of homes relative to rents, price of homes relative to affordability, everything is saying overpriced, bubble, likely to fall. So that's the backdrop as you make a purchase decision. I want you to try to find some place where it's less than a third of your income and you can justify it on the parameters we talked about. So kind of wrapping it up for today, I mean, my perspective is really a macroeconomic one, but also somebody who's trying to look at studies and what I lecture on, what I invest upon, what I've seen in markets. And one of the things as an investment banker we really were taught was how to understand the give and take of markets and that they can be inefficient for periods of time. And they can be overvalued or undervalued for longer periods than we would expect. But usually the fundamentals come in, and eventually we do have a reckoning or a correction that happens. It's usually unexpected when it happens, and it's usually some extraneous variable that occurs that nobody really saw coming, but it does happen. And so I think that we're in a situation like this where we have to look at the big picture perspective where we've had a everything bubble. Housing prices are sky high. Stocks in terms of valuation, when we look at PE ratios, are very, very high. When we look at a relationship to the gross national product or the GDP, look at the national income of America versus our stock market, we're at record territories. The Buffett index that he likes to look at, when the value of the stock market versus the value of the economy, we're at record levels, 200 type percent, and normally we're 100, 130%. We're at 200 there. Bonds have been in a bubble for decades. Stocks in a bubble, real estate in a bubble. It's just a difficult time to navigate right now, and whether we like it or not. But I think it's particularly risky in a personal sense with housing. And so in this instance, I would say it probably makes sense to let the markets correct and you just save your money. Become an investor. Think and prepare. Have your emergency fund. Have your finances in order. Work on your credit score. Focus on having a good balance sheet. Think of yourself as a finance operation. You do not want extreme leverage. You don't go and borrow 97% to go buy a stock. you would say, well, that's way too risky. The stock may not go up. Well, I want you to apply that same mentality to a house. The house you buy is one house in one neighborhood, in one city, and you may get it wrong. It's just like buying one stock. So you don't want to leverage 33 times to 1 when you make that purchase. When you get to a point where you're putting 30% down, 40% down, 50% down, our ratios are coming into line when we look at rental income to our cost of housing for our payments. It starts to make sense. The leverage ratio starts to make sense when we look at capital. If you put 40% down, it means you're borrowing 60% and you're more in a 1.5 to 1 ratio, not 33 to 1. So your perspective is not only less risk, you can ride it out. Banks are more willing to work with you if you get into trouble. You can obviously sell the house to get out of it if it's an issue. You can rent it out. Then you're going into it from a perspective of strength. That's what I'm looking for here. You go into it confident. Then buying a house makes sense. I would still say it should not be the lion's share of your finances, though. This is just my opinion. I think buying companies, businesses, or even owning your own business as well and investing in that as well, those are something that you can really increase the value. Housing is where you live. It can be a good investment if you rent it out and you have the cash flows and they make sense. But I would still argue I would rather be an investor in portfolios of companies, businesses that can reinvent themselves, businesses that can get patents, businesses that can grow and prosper and increase margins and develop new ideas, do mergers, acquisitions, grow the value of the enterprise. That's where most of your wealth should be, not in a leveraged bet on housing. I would have a portfolio of rental houses as well, so diversifying it that way. So in the big picture, I want you to look at housing more this way and not to jump into it and repeat some of the mantras we hear about how housing always goes up and buy as much house as you can. So if you like this content, what I'd like you to do is to like and subscribe and share and write comments. Let me know. I want to give you a different kind of perspective of my journey and my walk. And for someone who teaches every day, someone who lectures often, somebody who studies all the time, and as my friends and family and students say, talks a lot and has something to say. But I want to bring it to topics you're interested in. And I had people talk about housing. So let me know if this is of interest to you and you want me to dig a little bit deeper, and I can give you some more ratios and some ideas. But I'm going to give you a comprehensive look where we live, so that it's not only just your finances are in order, but we need financial sustainability to have a lifestyle to care and love and take care of others and those aspects. That's why finances are important. And so from that perspective, I always look at sort of what's the overall effect on one's life. So that's my perspective on this, to not let housing wreck your life, but to be something you enjoy and you do it at the right time in the right way. So I'll see you for today. Good morning, and have a great day. I'll see you soon.